Hello traders, welcome back to the Forex Geek channel where we dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about the Deep Pullback Strategy, a powerful approach that can significantly help you enhance your trading performance. This strategy allows you to enter trades at optimal points by taking advantage of substantial retracement within a trend. You will discover how to identify these opportunities using key tools like the moving average and Fibonacci retracement level. So stay with us until the end of this video to learn how to implement this strategy effectively and improve your trading outcome. Now, what do we understand from the deep pullback strategy? Let's talk about understanding what exactly deep pullback is in the forex market. A deep pullback occurs when price moves significantly against the main trend, creating a temporary correction. Unlike shallow pullbacks that barely retrace, deep pullback offers more substantial price movement, typically reaching key technical levels. Now let's look at this. We are seeing a shallow pullback. This is a shallow pullback. Price made a series of, let's start from here, lower, a higher low, a higher high, a higher low. This is a higher high, higher low. You can see this pullback is a very shallow one. This is a shallow pullback. You can see it's not even up to, it's very small. If you check the pip gap, you can see it's like this is just 12 pip move. While a deep pullback is something like this, from the higher low to the higher high because it broke this previous high, and you see how deep the pullback it pulled back as deep as more than 50% of the initial move. More than 50% of the initial move. When you are looking at deep pullbacks, you are typically seeing price retrace to major support and resistance level. This can be the 100 period simple moving average or significant Fibonacci replacement levels, particularly the 50% on the Fibonacci replacement or the 61%. So to show that this is a pullback, let's use the Fibonacci tool to see how deep this price pulled back to. You can see from the higher low to the higher high, you can see that price pulled back to more than 50%. Like we said, it has to pull back to particularly 50% or 60% or lower. This is an example of a deep pullback. This deep move often frightens new traders, but they actually present some of the best trading opportunities. We can also use the we can also understand that these pullback are being used with significant trading tools like the 100 period moving average. Let me turn on the 100 period moving average. 100 period moving average acts as a dynamic support and resistance level, often catching these deeper retracements. As you can see, price reacted from this area, it pulled back and it wicked the 100 simple moving average, and it continued to the upside. So that's what we are saying. These are the levels that price can respect. While the Fibonacci 2, particularly the 38%, the 50%, and the 61% levels, help you anticipate where this pullback might end up reversing from. As you can see, these are the areas you can anticipate the pullback from 50% to 61%. Remember, the key difference between a deep pullback and a trend reversal lies in the overall market structure. In a deep pullback, the main trade remains intact. You would still see higher highs and higher lows in an uptrend market, or lower highs and lower lows in a downtrend market. This distinction is crucial for your trading success. So let's see how we can trade using the deep pullback strategy. Now that you understand what the deep pullback strategy is and how to identify them, let's dive into how we can trade using this strategy. This approach allows you to enter trades at optimal levels, improving your risk to reward ratio, and aligning your trades with prevailing trend. The first step is to identify the trend. You need to determine whether the market is in an uptrend or in a downtrend. Look for the higher highs and higher lows like we showed you here. You look for higher highs and higher lows to see the market is really trending. Then in case of a bearish market, we look for the lower lows and the lower highs. You can also use the 100 period moving average as a guide. You can use this 100 period moving average as a guide to help. So if price is above the 100 period moving average, it is called an uptrend. And why if price is below the 100 simple moving average, it is called a downtrend. Now once you can identify the trend, the next step is to wait for a deep pullback. You have to wait for a deep pullback, and you need to confirm the trend continuation before entering a trade. You can use candlestick pattern like a bullish engulfing, hammer candles in an uptrend, or in a bearish trend. You can look for the bearish engulfing, or you can look for a doji candle to confirm that price is ready to resume its trend. You can also make use of momentum indicators such as RSI or MACD. They can also provide confirmations to show about your reversals or your divergence. Now let's look for an example in the bullish trend. Once you have confirmed it's time to enter your trade, for in an uptrend, place your buy order after your confirmation of the support of the deep pullback. For a downtrend, you place your sell order after the resistance is confirmed at the retracement point. So for an uptrend, like I said, we enter the trade after we have confirmed a bullish engulfing, a candlestick pattern. Okay, let's use this as an example. This is actually a very good trade. We saw price broke structure at this point. When price broke structure at this point, it came back to pull back. After it came back, we saw a bullish engulfing candle, and at this point we can enter our trade. If we enter our trade, we can put our stop loss just below the pullback for longs. Just put it below the pullback to ensure that our risk is limited if the market moves against us. Finally, we have to define our profit target based on key levels such as previous swing points, the highs and low of Fibonacci extension such as 1.618 level. You can also aim for a favorable risk to reward ratio, idealistically 1:2. Like I will use 1:2 at this area, or 1:3 as the case may be. These are the ways that I can highlight taking profits. We can also decide to take profits at previous swing high or previous areas where price have reacted from in price at the past. To get such an area, we will need to, okay, like see this area here, can take profits at the previous high area. This area here is the previous high, reacting from where we expect price to get there, and we take profits at such area. Following these steps, identifying trends, waiting for deeper pullbacks and confirmation continuations, and managing risks, you can effectively trade using the deep pullback strategy. Remember, consistency and discipline are crucial for a long-term success with this approach. Alright traders, I believe we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences while trading. If you found this video helpful, please do well to to like, to share, and you turn on your notification bell so that when we drop a new video, you wouldn't miss out on our trading tips and strategy. Thanks for watching, and I will see you in the next video.